Hello, and welcome back to DoubleLine's Channel 11 News. I'm Ken Shinoda, your host today, Thursday, December 17th. This month feels like a December to remember, but this year, 2020, is a year we all want to forget. It's been an oddly busy December, usually a slow month. Maybe it's because we're all stuck at home and have more time to work or trade our PAs. That's been the story this year with the spike in retail trading. A new hobby, some speculate, has helped to propel many assets higher this year. Others point to Superman Jay Powell, chairman of the Federal Reserve, and his ultra-accommodative money printing machine. He's not alone, of course. He's had a little help from the debt binge going on in Washington. Whatever the reasons may be, it turned out to be a pretty jaw-dropping and awe-inspiring year for many risk assets. In some markets, asset returns are nowhere close to what forecasts predicted at the beginning of the year. Most investors expected returns to be lower this year given the pandemic, the large drop in global GDP, elevated levels of employment, and the lockdowns crippling small businesses globally. But here we sit with returns looking pretty good. Developed global equities in dollar terms are largely in the green, led by the tech-heavy NASDAQ up a whopping 43% year-to-date, the S&P up 17%, and the Dow up 8%. Over in Europe, Euro Stoxx 50 is up 6% after adjusting for the currency appreciation of the euro against the dollar. Emerging markets also continue their upward march, with the broader MSCI up 15% year-to-date, led by tech-heavy Asian markets. However, more recently, we've seen a big rotation and a catch-up by LatAm and EMEA. This catch-up theme can be seen across all equity markets as the laggards of yesterday become the winners of today. The great rotation seems like it'd be in the first innings as a rollout of the vaccine, hopes of another fiscal plan, and accommodative central banks allow markets to look forward to a more normalized economy where many of the cyclical names could prosper. Many of the relative outperformers have started reversals, and it's worth watching. US versus global, US versus Europe, developed versus EM, and of course, growth versus value. The bond market was not left out of the land of gains. Who would have guessed that the carnage of March and April would lead to high-yield bonds being up over 6% this year, and corporate bonds with their longer duration up over 9%. Only the more COVID-affected parts of the bond market continue to struggle, as is the case in the equity markets. Commodities also joined the land of gains, with largely everything but energy-related assets being up on the year, especially precious and industrial metals. With such strangely good returns, given what happened this year, investors are surely wondering how to position next year and what to be thinking about. Here to help us look back on the year and towards the light at the end of the tunnel in 2021 is my friend and colleague, Sam Garza. Sam heads our CLO team, but also is one of our best macro strategists here at DoubleLine. He joins us on Zoom today, very fitting for 2020. Welcome to the show, Sam. Welcome to the show, Sam. Excited to have you here. It's been a crazy year. I thought we'd talk about kind of the weird things that happened in 2020. I know everyone's looking to have 2020 behind us as we look forward to a new year, and talk about maybe what you think is in store for us in the year to come.
Thanks a lot, Ken. Good to see you as well, even though it's remote. I guess this is appropriate for 2020. Thought I'd start out with a little bit of a look back at 2020, the year that was, the year that's almost over as we record this. All year long, I've been thinking about this quote, this Lenin quote that's been repeated over and over again. I'll just read it. There are decades when nothing happens, and there are weeks where decades happen. And that, to me, and I think most of us, feels really appropriate for this year.
Absolutely.
Just on and on and on. And they're, trying to think back to even the summer of July, or even pre sort of COVID back in February. It just seems like a lifetime ago. So I thought that quote will be overused this year, but it's really appropriate. So I'm going to start off with some slides, just looking back at 2020. I think the point of what I want to talk about here, the message to get across, is just how very unique this recession, this crisis was or has been compared to everything we've seen in the post-World War II era. And I think we'll go back during our conversation back to World War II a couple times, because that's really probably the best comparison. The first slide that we're going to look at here is looking at goods and services spending per year. And this chart only goes back to 1990, but you got a nice comparison to the last recession we had. The black line is goods spending and the red line is services. Back in 2008, 2009, we saw a deep decrease in expenditures on goods. If you want to think about, buying refrigerators and things like that, during that crisis, folks stopped spending on that. But largely, services, restaurants, and the like, haircuts and whatnot, that spending did go down, but it didn't go down that much. And you can really see on this graph that there's sort of a big contrast with the deep reduction in services spending and the actual increase in goods spending. There was initially a reduction, but then there was a large increase. It's just sort of, to me, this is one of the charts of the year. And if you think about it, folks couldn't go travel. They couldn't, in many cases, go get haircuts. And there was a lot of home renovation spending. There was a lot of spending on goods and appliances and things like that. Folks were spending more time in their home. And so they were spending the money there as opposed to spending on services. And I think we'll come back to this concept as we look forward into 2021, and hopefully the recovery takes hold and continues. One has to think how much of the spending on goods has sort of been front loaded, how many appliances, how much home renovation has been already sort of taken care of now and sort of front loaded, and what that might look like in the years ahead. We might have a pretty big reversal there.
Yeah, that's it's funny when this all happened, there was a rush to go buy exercise equipment and stuff for your kitchen because you're cooking at home. And I mean, I was trying to buy weights. You couldn't, they're sold out for like months and months and months. But you only need that one time, right? I mean, it's not like you need multiple Peloton bikes. So I think you're absolutely right in the sense that we've seen a lot of front loading of buying stuff so I can use it at home. And you couldn't even go use the services if you want to, if you live in some of the places like California where you're supposed to not go right now. But it's been just a lot of bizarre things like this that I'm sure you're going to walk through.
Yeah, absolutely. I mean, another example similar to you, I wanted, like many, to buy a chest freezer, and it took about 4 or 5 months to find one available. I don't think I'm ever going to buy one again in my life, and I think that the things like that, appliances like that, have been probably bought ahead for the next 5-6 years. So it's it's been interesting this year, and how that plays out going forward will probably create a different type of recovery. The next thing, we know that the last recession back in 2008, 2009 was consumer led. It was really the center of gravity was in the mortgage market. There was a lot of very loose lending in the mortgage market. As we all know that narrative. And what this chart shows is the consumers with new bankruptcies today versus back in 2008, 2009. This recession, again, was very unique, and we didn't, in large part due to the initial government support. We're not seeing that spike in bankruptcies across the board. I mean, this isn't, you've got the national average there, you've got various states, but there's a very large increase back up to 5-6% in cases like Nevada. Those numbers are still pretty low on average. We have seen some spikes. I don't have the charts here, I don't think, but you've seen increases in some auto loans, but those have come right back down. So I think this sort of really highlights, again, the uniqueness of this recession, where you don't have that spike in consumer defaults.
Yeah, I think two things helped with that. One was the consumer, I think, was a little bit more conservative going into what happened in March, just as a function of living through the global financial crisis. So the savings rate was already elevated, and then clearly aggressive fiscal policy and unemployment aid is helping the story there. So that's something that we at DoubleLine are watching is, if that, I know we have another fiscal plan imminent, it's supposed to be today. I don't know if I was driving here, did they announce it yet or not? Or
I don't think so, not yet.
Yeah, so, but that would help, again, add more aid. So it just kind of pushes back things, and hopefully, the economy can heal and people can get jobs. But that's definitely something that we're watching. We saw a recent spike just this month, but historically, the wintertime is seasonal. People buy gifts instead of paying their debt. So we have to kind of also wait and see if that seasonality is true, or are we actually starting to see a spike in consumer delinquencies?
Yeah, absolutely. That'll sort of set the tone for 2021. I mean, I think you mentioned an important thing that, again, we'll come back to here, which is the fiscal these fiscal transfers, this fiscal spending, that is, I think, going to be really, to me, one of the key risks to the market in 2021. And so we'll see how that sort of plays out. And we'll come back to that again in a couple slides.
Okay.
Next slide here. This is looking at global trade, again, compared to the last recession back in 2008, 2009. That's the darker blue. You can see that global trade, it took about 4, 5, 6, 8 months to reach a bottom. And then it took another year plus to really sort of rebound. And you can see how quickly it's happened here. We had a very steep, rapid decline, drop of basically about 15%. And then a really quick rebound. All of that happened within 6 months. And I think if you look at a number of slides, there's very unique aspects to this recession, not only in some of the things that I've shown already, good spending versus services, but also in how quickly we've seen a rapid decrease and a rebound. And I think that's in part due to the unique nature of this crisis, but it's also starting to feel over and over again like things are happening a lot quicker, not just in markets, but in politics and the economy and everything else. So it's this chart sort of really graphically shows how quickly this recession reached a deep level and rebounded.
I guess this is one place where you actually see the V that some people were hoping for.
That's right. That's right. Yeah, this is our V recovery chart. And speaking of the shape of the recoveries, this is there's been a lot of talk, especially early on. Would this be a V? Would this be an L? Would this be a U? All of these different letters to try to describe the recovery. And I think the idea of the K-shaped recovery is one that really resonates with me. What we're looking at here is a chart showing the employment rates by different wage brackets. And so what you see here is the highest wage earners, that's the red line. They've mostly recovered, actually they have fully recovered, and their wages are actually up 20 basis points since the start of the year. Whereas the, we'll call it a green line, the middle wages are down about 5%, and the low wage, those are down 20%, those employment rates. And if you think about a lot of the low wage, that is in some of the areas most hard hit. Think about restaurants and hotels. And a lot of those, the recovery in those sectors has been very slow, and is still, sort of ongoing. And I think, this has really exacerbated one of the big issues we have in our society, which is the wealth and income inequality, which we'll get to. But to me, at least so far, the idea of a more K-shaped recovery is one that sort of resonates.
Okay.
All right. I talked about things happening more quickly. And to sort of finish off thinking about some of the things of 2020, what this chart just shows is how quickly it's taken these various pandemics or contagious infections to see the first studies all the way to a vaccine. And all the way at the bottom is the vaccine development and actually the rollout for the COVID-19. And you can see that's just barely a blip. I mean, this happened in 9 months. It's truly amazing to sort of see that sort of development. But you can see the arc over time. A lot of the vaccine developments were measured in decades before, and now we're talking about something happening in less than a year. So we sort of named this title. Feel like things are happening faster. They are. This chart truly shows that things are happening a lot quicker these days. The market sort of knows it, prices things very quickly. We can see that in credit markets, some other markets we'll talk about during the presentation.
Did you watch the first vaccination in that woman in the UK?
I didn't. No, I did not watch that one.
Well, it's funny, when you're talking about how things move so quickly, like we're just so busy and getting hit with so much information. I'm sitting on my computer. I've got text coming in. I've got Bloomberg chats coming in. I've got a Zoom, a Teams call going, a Zoom call imminent, and I've just got CNBC on in the background. And I mean, it's a pretty momentous occasion for us, to see that happen so quickly. And yet it's just an afterthought. We're like, oh, okay, the vaccine's here. We knew it was going to be here, and here we go. Right. Everything hopefully will be better. And, it's pretty remarkable how we're, just moving through this whole cycle right now.
Yeah, absolutely. I think so many aspects and events this year have been truly historic for society, for the nation, for the world, that it will take some time to sort of put all of this in context. But clearly, what you described, that video, I think will be something that will be, years from now, sort of looked at as sort of a hallmark the beginning of hopefully the end of the pandemic. But yeah, there's been so many events this year. It's really, I think, going to take probably decades to sort of put it all in context. It's pretty momentous. And here's so sort of rounding out 2020, taking a look as we are recording now. The year's not quite over, but getting pretty close. And I think, going through the depths of March and early April, which you and I can both remember, sort of sitting on our virtual desks, to look at the results here of different asset classes is truly amazing. And I'm going to sort of start. We've got this section by different major asset classes. We've got equities, fixed income, FX, and commodities or real assets. And all the way off to the left, you see the S&Ps as, again, it's up about 16%. We got the NASDAQ up 40%.
Wow.
Global equities up 15%. And again, these are year-to-date numbers. The Nikkei is up 20%. Even, the Barclays Ag up 7%. Great year for core fixed income. The dollar's down about 6%. The commodity index is down about 6%, although rebounding a lot more lately. Gold's up 21%. And interestingly of all, copper on the year up 27%. Copper often thought of as, sort of a barometer for global growth. And I think, you look at a chart like this and you might have never known that we had, sort of a once in 100-year pandemic. It's really a testament, I think, to the power of central banking and also to some degree, the fiscal spending that's gone on to sort of support the economy.
Yeah, I mean, if you had asked me what returns were going to be at the beginning of the year and things felt pretty good right at the beginning of the year, I wouldn't have guessed they would be this strong, right?
I agree.
Kind of maybe your standard up 6-7 in equities. And I mean, if you had talked to somebody in March, you thought things would be down on the year still. And it's pretty, I think it's the central banks, for better or worse, they stepped in much more aggressively, much quicker. It seemed like we went from the announcement of QE4, was it on like a Friday QE4? And then by Monday, or like a week later, we had QE Infinity, right?
Yeah, that was decades ago in my memory, like I was saying.
Yeah.
So I sort of remember what day of the week. I think, one thing, obviously the standout here is the NASDAQ up 42%. Big tech has been clearly sort of really benefited from this, not just the support of the central banking, but also just, the sort of the concentration. Think about your Amazon versus retail sales in your local community. Really been a lot of sort of concentration in some sectors here.
Well, it said, one of the things is that the stock market's not really all the economy. The stock market's the largest and strongest companies that are global and have diversified businesses. And it seems like who's suffering the most is small business, which is a large part of the US economy, but that's not the stock market, right? And you kind of see it when you drive around. I'm in downtown LA, sitting in a building with 20 floors probably empty. The stock market's not a true reflection of everything that's going on, right?
Yep, absolutely. Yeah, and that's something as we move through this crisis and hopefully again, through the recovery, the ramifications of that dynamic, I think are something that are going to really sort of, we're going to have to sort of struggle with how we want to work through our recovery. We've spent many years with, sort of on the central banking, liquidity, basically tsunami. And that's gone to places like financial markets and less so to small businesses. And even, like you were saying today, the small businesses have even uniquely suffered in this pandemic versus, again, using the example of Amazon.
Yep.
So that's 2020. I thought, start to look forward a little bit ahead through 2021. We'll still have to sort of, digest 2020 and it'll come back up over and over again, but we'll sort of look ahead at 2021 and go through some slides on the economy to see if we can make sense of it. Does that make sense?
Sounds good.
All right. So the first place that we like to start is where are the forecasts? And this is from Bloomberg, the top line, which is it's a dark gray. It says 2021.
Better than the last 10 years.
That's right.
That's going to be better than the last 10 years.
That's point one. Is expected growth for 2021 is up at 3.8%. That's real growth, real GDP. We'll get to inflation in a bit. We have, I think, some unique things to say about that. But obviously, you can see 2020 was a really bad year. So that was down 3.6%. We're looking at up 3.8. Put it together, sort of a zero, a couple of year growth rate. It doesn't quite work that way, but just sort of roughly speaking. But yeah, that's one of the points that you can definitely take away here is that 2021's so far expected to have much higher growth than we've seen really the last 10 years, the entire post-recovery period.
I mean, I guess you would hope that there's going to be more growth with the amount of fiscal stimulus we pumped in. I mean, the last decade was all monetary stimulus. So now we finally got that fiscal spending. So you would hope at least that's going to create higher growth, right?
Yeah, that, and I think there's a lot of pent up demand for services. Just sort of anecdotally, a lot of folks I talk to are really getting a little more tired of cooking at home, and they're giving every indication that once they can, they're going to just sort of eat out at restaurants as much as possible. I mean, that'll be, I think, a large boost to the economy is when folks are able to get out. There's a lot of pent up demand to sort of get outside, to travel, do all the things that at least for the past 9 months have been pretty restricted.
Yeah, even just getting in my car and driving here was a nice breakup. Listening to the radio, nobody bothering me for a little bit. It's amazing. Used to hate commuting, but if you do it a couple times a week, I mean, there's no traffic now. It's just the little things that you take for granted, right? I hope everyone learned about that during this time.
I definitely think that's one of the takeaways. That, and being at your house is great, particularly in the beginning. But after a while, it's nice to get out, and sometimes it's even nice to get to the grocery store.
Absolutely, or just see some friends, right? It's
Exactly.
Things to look forward to in 2021, hopefully.
Exactly. And when you want to look at the bright spots of the economy, I think it's been out there. It's really the home builder market, the real estate market within the U.S. what we're looking at here is home builder confidence. This chart goes back to the mid 80s. This measure is really just off its highs. Pretty amazing to think about. And I think as there's a lot of drivers to this. There's a lot of the talk about urban to suburban migration. And those dynamics. There's a lot of home building going on. There's really low interest rates, and as we saw a few slides ago, but bankruptcies aren't that high, so there's still sufficient lending going to this market. So it's been really interesting to watch how robust the housing market has stayed over the course of this year. It's just gotten so much stronger after the initial sort of shock of the lockdowns we experienced back in March.
Yeah, being a mortgage investor, it was nice not being the epicenter for once.
Exactly. I think you probably cleared that out for your career.
Yeah.
In the last cycle. Still on that sort of topic. I mean, I think this chart just confirms the prior chart. This is looking at the mortgage purchase index. Again, not quite at all-time highs. We know that the last, the 2000s were pretty unique. There was a lot of really loose lending going on there. So I don't necessarily think it's entirely appropriate to compare it back to the 2000s, but you can look at this measure is the highs of this cycle, and that is going back to sort of the 2009 frame. So again, really interesting to see this part of the market, which has just been the strongest part of the U.S. economy, and this is a large and important part of the economy. There's a lot of jobs there, and it's something it's really been chugging along. So it's been really one of the bright spots for the American economy this year.
Yeah, I mean, you've heard me say it over and over again, but a lot of it really had to do with supply. There just wasn't enough homes going into March, even before COVID. The existing inventory of homes for sale, that data statistic started getting calculated back in 1983, and it was about 2.25 million homes back then. 1983. I mean, think about how much smaller the population was, and today the existing inventory was 1.5 million going into COVID. So we just don't have enough homes relative to the demand. And that's why I think you actually might see some of the housing numbers turn over. The home builders, they can't build homes fast enough. There's not enough labor. There's going to be kind of a bottleneck for that. But it's absolutely great for the economy. And of course, average 65% of Americans own homes. They saw their home prices fall 35% during the global financial crisis, which has them pull back on spending. And having home prices not go down, I think definitely helps the consumer stay more resilient, especially since they're all refinancing into historically low mortgage rates, right?
Absolutely, yeah. You brought up a word, bottlenecks, that I want to sort of come back to a little bit later. But if you think about the last cycle, those excess homes, I think there were stories of homes being raised in Detroit and some other areas. Sort of the inevitable outcome of that was that there would be a lot less new homes brought to market in the years immediately after the last financial crisis. And we saw that. And, to your point, we're already running with really a housing shortage as a result of the last cycle. And now you add on to it, as you mentioned, the low rates and there's clearly seeing a lot of folks moving to certain areas, Texas, Utah, Florida, and whatnot. And so that's creating a lot of demand for that single family housing. So it's really sort of put into overdrive the experience we've had the last really 10 years after the period where we had too many homes.
Yeah, I mean, people say, oh, the flight to the burbs, all that stuff had already started. People were already moving out of expensive cities to either suburbs or moving to cheaper states. Because in the big cities like LA, a one-bedroom apartment up until March was up 65% over the last 10 years, the price of a one-bedroom apartment. And so it's COVID, just kind of the pandemic just sped up a bunch of stuff that was already happening. Themes that we were already seeing, the move to e-commerce, right? The move to the burbs, working from home. People have been trying to pitch telecommuting for decades, right?
Yep.
But it's, I think this has sped that up. And of course, technology today is way better than it was even 5 years ago, that it's allowed us to be able to just do things like this, right?
Yep, absolutely. I think, had this happened in the year 2000, we wouldn't see this. Really, folks, I think, are learning now that they're becoming sort of untethered to these urban centers through the use of technology. Now, I think, the real trick, I guess, or the real interesting question will be how much of that sort of holds. I tend to think we'll see some reversion, but the trend, as you mentioned, has already been sort of something that we've been seeing ongoing, and the COVID-19 pandemic definitely seems to accelerate a lot of trends in place. And I think it's, creating sort of this complete sort of mix shift across the country. You're seeing a lot of folks moving. We've had a shortage of housing in Southern California for really a decade now. And that led to the higher home prices that you mentioned. And so now, folks are figuring out, I can work from home in, Salt Lake City, where the cost of living might be half of what it is in LA. So it can make a lot of sense.
Yep.
All right. So I mentioned a few slides ago, just sort of talking about this dynamic with wealth and income inequality. And I think it really comes into play in a number of different areas, particularly this year. The chart here is looking at this is the history of the minimum wage. And it goes back to the 1940s. And the blue line is sort of an approximation of the real wages. It's the minimum wage nationally, so it's not exact calculation, but you can see that in the orange line, that is the unadjusted actual minimum wage. And then the blue line is sort of trying to take a look at what it's meant in real terms. And what you can see is that wages have really been coming down, at least the minimum wage. And I'm using this as a proxy for wages in general, particularly at the lower end of the income strata. And there you can see that, really sort of peaked in the 60s and 70s, has been coming down since then. And there's been no real increase in minimum wages since the 1990s. And I think there's a lot of factors here. There's global trade, there's demographics. And I certainly think in the last 10 years or so, not so much affecting this, more affecting wealth inequality, but there's been a high reliance on central bank liquidity because of, in some ways, and because of politics, it's been really difficult to sort of push through, some fiscal spending bills, or there's been actually the opposite movements after the last financial crisis. There was a sort of an austerity movement, the Tea Party movement here in the US. That all seems to be in shift. And that's, I think, should be, that's one of the themes I think a lot about, particularly through this crisis, is how much that is being addressed. I think, more recently there was a discussion and actually the passage of a law in Argentina for a one-time wealth tax to sort of pay for.
Yeah, I saw that.
So these movements, this movement towards fiscal spending, and I think this will be sort of one of the defining features of the recovery is our governments able to sort of really work in that direction, move in that direction, or is there continued gridlock, which leaves us reliant on central bank liquidity, which again probably exacerbates the problem of wealth inequality, at least probably impacts income inequality as well, but definitely wealth inequality.
Do you know what the largest driver of the adjustment is? Is it shelter? Is it shelter and food? Because I know if you look at the number of apartments, for example, that are considered on the lower end affordable, which is apartments that rent for, I think the number that this Harvard study has is like 800. It's just dropped dramatically, and 800 is a lot of money. And so the just available of lower end housing units in the US has come down so much over the last 10, 15 years that you got to believe that things like that play a large part of why that adjusted minimum wage is so low, right?
Yeah, I think, that's probably it. And we've got some other slides here to sort of try to flesh out this issue.
Okay.
We'll get to those in a moment, I think.
Cool.
Similar vein. This is a pretty interesting chart. It's unique. A lot of red lines on it and different annotations, but really I just sort of, focus on the blue line. And the blue line goes way back. And this is meant to sort of capture how long it takes the average, how many average working hours it takes to buy the S&P 500, that, the stock index itself. And as you can see, that number sat around 30 hours for over 100 years. I mean, I don't, how accurate this chart is going back, through before 1900, well, not sure, but I'll sort of take this graph for what it's worth. It sort of feels a bit right. And then you can see around the 1990s, that number started going up, and around 2010, the recovery from the last credit crisis, you see that number really just sort of skyrockets up to 120 hours. And again, I'm gonna probably sound like a broken record through parts of this presentation, but the reliance over the last 10 years of the recovery on central banks, which initially was needed, we had a credit crisis, has led to these charts like this, where you have something stable for 100 years, and it sort of goes off the chart as a nation continues sort of financialize the economy. So I think, this is to me at least is pointing out that there's something very interesting happening in our economy. It started in the 90s and it really took off in the post global financial crisis.
Yeah, I mean, it really looks like it started kind of in the early 80s, right, when we entered the debt-fueled system that we've kind of built globally, right?
Yep, absolutely. I mean, and there's other things in here. There's there's sort of the foundation of the World Trade Organization in the mid 90s. There's China. There's a lot of contributing factors to this, but it still sort of points out, I think, a glaring difference between income and what's happened with our, the prices of assets.
I mean, this is like another way to see that the Wall Street is so separated from Main Street, right? Absolutely. I mean, the stock market the average person is not invested in the stock market, right?
Yep. And you mentioned a couple slides ago. I mean, I think what this chart shows is the red line is personal wages over GDP, and the purplish line is corporate profits as a portion of GDP. They're different scales, to be sure. And you have to sort of look at that. The personal wages is on the left, but there's a general trend here, and the trend is that personal wages as a portion of GDP was up to around 52% in 1970. It's come down. It bottomed out near 42%. It's currently sitting at around 45, and not so much since the 70s, but since the 90s, that same time period we were looking at, you can see corporate profits have gone from about 7% to double digits now. And I think, one way to look at this is to just, thinking about the economy becoming more financialized, thinking about globalization. That's led, your workers, your manufacturing in, call it Detroit or the Midwest. A lot of those jobs have sort of gone over to China, where they're able to sort of produce at much lower costs. So there's been another thing that's happened over time. The actual wages for the average American have gone down as a portion of the economy, and profits and margins have sort of gone up. The reason why I'm adding these into this presentation, hopefully comes out through the course of the presentation. It feels like we're in the midst of, again, a sea change, or at least, trying to make that decision. Does it make sense to keep trying to pour more fuel on the fire in terms of central bank liquidity, or is there going to be more fiscal spending or different, higher taxes, or sort of different orientation to try to bridge some of the wide divergences we're seeing between sort of income inequality and wealth? Okay, so taking a look now, this is looking at the budget deficit in the US. It's sitting at negative 15%. We've done a lot of fiscal spending this year to try to help out the folks who couldn't work. We, for years at DoubleLine, have been looking at this chart and just sort of noting that the red line was getting more negative. So this is, of course, negative. The federal deficit as a portion of GDP is at negative 15%. And we were noting how we were in this recovery from 2016 coming into this year, and still the budget deficit was increasing. And typically you see the budget deficit increase through a recession and then recover out of that. And this time we were noting how we're not even in a recession and this number's already rising. And then we come into 2020.
We were in the greatest economy ever.
And then we came into 2020, and the number just went from -5% to -15%, really just off the charts of this chart that goes back to the late 60s. So it's really a prime feature, I think, of what we'll be sort of dealing with in the coming decade, which is government spending and how how that financing of that sort of takes place.
Yeah, I mean, it seemed like the market used to care about deficits, and now the market just doesn't care at all. Whether it's right or wrong, to be determined. But the I think the stock market, the bond market, and also it seems like politicians are just getting way more comfortable with carrying more debt, because up till now the ramifications have seemed to be limited. Right? Japan's been doing it for an awfully long time. I feel like you can do it until people stop believing in your currency. That's why Argentina can't do it, right?
Yeah. I would go so far to say it's not just that folks don't care. It's actually completely switched on its head, where less fiscal spending is actually, particularly in the midst of a crisis, which we are in right now, but less fiscal spending is perceived as a bad thing. Here we sit today having to undergone what seems like 6 months, or what almost seems like 5 years of daily discussions about when the next stimulus package will come. And when it seems like it's coming closer, the financial markets tend to generally rally. So there's definitely, I think, the potential here that we've completely switched into a new paradigm where it's actually the market's looking for more government, fiscal spending in general. And which leads us to the debt to GDP. We've been looking at this chart for a long time. The number's been going up. I think it's really helpful to have this chart that goes back through World War II. In many ways, the COVID-19 pandemic is sort of like our World War II, in a sense that it's been basically feeling like we're at war, and it's a crisis of that sort of proportions in many ways. Of course, there's a lot of differences, but what you do see here is the debt to GDP ratio. And the scales are a little bit, they look a little bit different, but they're basically capturing the same thing. And we're essentially at debt to GDP ratio here in the US, where we peaked in the 1940s. And I'll in a couple slides here, I'll sort of talk about what we did after the 1940s to sort of work down that debt. But I think it's really interesting to sort of note that we're sort of in that similar zip code where we reached a peak and went around. And I'm not at all saying that's going to be the case now, but here we stand. On that same note, this is a look at year-to-date change in debt to GDP, sort of just reaffirms the prior chart. This is not just government debt. This is looking at households and non-financial. So there you have Canada up at the top. In total has increased their debt to GDP by about 80%. The US about 50%, about half of that's coming from the government, but even households to some degree and non-financial corporates have. But it's not just the US, as I mentioned, there's Canada, there's Japan, there's UK, there's even China. So, if you sort of just strike an average through here, you're somewhere around 20 to 30% increase. So it's been a really monumental year for increases in debt to GDP, pretty much across the developed and much of the emerging market world.
It's good to be a bond salesman, I guess.
Yeah, that's true. And so as we think about 2021 and the outlook for the economy, recently Deutsche Bank did a survey, and the three risks that came up the most, the first one was the virus mutates. The second was there was serious side effects in these vaccines. And the third one was that there's a general reluctance to take vaccines. And I think those make a lot of sense. When I think about 2021, I think of a year of recovery. We have a vaccine, and really what would give me sort of pause would be first, any of these three aspects I mentioned about the vaccine. And then I think, I don't think it's quite on here. It's somewhere down below maybe, but it's the political polarization. And really the way that sort of comes into play, I think, is how that plays out in terms of any either future fiscal stimulus. There's been a lot of talk of infrastructure spending. All of those, I think, can really give a shot in the arm to the economy. Assuming we have this vaccine with no issues, having more fiscal stimulus will really, I think, help to help the economy recover, and really could create a pretty dynamic year, similar to where the expectations are. But there's certainly risks going into 2021, and I think the respondents to this survey from Deutsche Bank really sort of captured what the number one risk is, and that is really sort of all hopes are pinned on the vaccines, the successful rollout of the vaccines with no real complications.
Yeah, no, we talk about it a lot. Is the vaccine stops the the symptoms, but it doesn't mean you can't give it to somebody else. So it's kind of like goes hand in hand with testing, and then people's willingness to not leave their house if they test positive, right?
Yeah.
So you're at kind of like the whim of not just your own behavior, but everyone else's behavior. Will that people keep wearing masks? I mean, here on the California, people are, at least in my neighborhood, they're pretty good about it. I know people in other states or cities, even in California, where, they don't think you need to wear masks still. So there's more than just the vaccine, I think, that needs to happen next year for it to be successful. Everyone kind of needs to be on board as a society to make sure we, take other steps towards the successful way out, I suppose, right?
Yeah, absolutely. Absolutely. There's a lot, I think, you sort of pinned it. There's a lot of unknowns. We don't know a lot about the vaccine and the rollout. So I think there's a lot of hopeful expectations there. And I myself am fairly hopeful. But there's certainly some unknowns there that could sort of come into play and give us, I could see there being scenarios where you have to sort of downgrade risk estimates or risk forecasts for 2021. But so far, it seems like the rollout's going pretty well. But that transition that you're talking about will be one that's not going to be a light switch. It's going to be more like a dimmer switch, going from really dim to hopefully bright. So that's the economy. I mean, I think, just to sort of summarize, there's some good expectations for the economy. And then there's also some risks. And then there's, I think, the COVID-19 pandemic has really exposed some of the fault lines in our economy in general. I've talked about wealth and income inequality, reliance on central bank liquidity. And then there's, we're sort of floating in this zone where maybe we're shifting paradigms to a little bit more of a reliance on the fiscal side. We've seen it this year. One of the real questions is, does that sort of continue? If we find ourselves, I think, in a world of a movement towards more austerity, that would be, I think, a big headwind in the years going forward.
Yeah, that would be clearly deflationary. But if we are truly in kind of this new paradigm of fiscal, then inflation is something maybe people really need to start thinking about for the years to come, which I'm guessing you're going to talk about.
Absolutely. Yep.